Canada's equity markets have been holding up relatively well this year, even as investors navigate rising oil prices and uncertain trade dynamics. For a closer look at how energy markets, trade tensions, and sector trends are shaping up in Canadian equities, we're joined now by Jennifer Nowski of TD Asset Management. Jennifer, welcome to the program.
It's good to be here.
We're not even 3 months into the year yet, early days. TSX, though, is up roughly 4% year to date. What's driving this performance, and how would you describe the current trading environment?
Yeah, so the TSX has really benefited year to date from its high exposure to commodities. If you look across Canadian and U.S. equity markets, the strongest performing sector year to date is energy, and materials is also up. The TSX has a 37% exposure to these two sectors, where the S&P 500 only has 5.7%. So as a result, the TSX is up slightly, whereas the S&P 500 is down about 1.9%. Now, of course, this is coming off a very strong 2025 for equity markets globally, including the TSX, which was up 32% last year. Now, in terms of the trading environment, it's early days, but I would describe it as rather choppy, and there's kind of two big areas that the market's debating. The first is the impact of AI, and specifically concerns around the IT software and services sector and how AI could potentially disrupt those businesses longer run in terms of competition or pricing. So there's been some weakness in that area. The second area is the volatile geopolitical environment, most recently with the conflict in Iran pushing up oil prices. While this is good for energy producers, it creates a headwind for consumers, economic growth, and could potentially increase headline CPI numbers. So those are just two factors. There's many other factors that influence the equity markets, and we'll be watching those over the next few months.
All right, let's dig into that oil market rally. From your perspective, how is that influencing the Canadian market? What investors should be aware of?
Yeah, so a higher oil price is positive both for the Canadian economy and for the TSX. Since Canada is a net energy exporter, it's additive to GDP growth. And on the TSX, the energy sector is about 17.7% of the index. Specifically, producers are 9% of the index. So they're seeing that uplift from the higher oil price. Now, when we talk about oil markets, of course, the first stop is what's going on with the oil price. And these days, that centers around the conflict in Iran. What investors are watching for is how long the conflict lasts, if flows through the Strait of Hormuz are able to recover, and how much damage or interruptions in energy supply that there is in the Middle East. The partial offset to this is the release of strategic petroleum reserves to try to kind of smooth over this volatile market. And it's not just the oil that's impacted. The Middle East is also an exporter of other commodities, including LNG, fertilizers, and aluminum. Now, for Canadian upstream producers, as I said, a higher oil price is net positive, and energy stocks do take their cues from moves in the oil price, so that's why we've seen this rally. However, when investors are valuing energy stocks, they do incorporate a long-run oil price, and that price is currently below the spot price. So that's where this debate around whether the oil price spike is temporary or has a longer-lasting effect comes into play. Now, lastly, though, the oil price spike does produce real cash flow for the energy producers, and they can put that to good use. Now, it's too early to say how much and what they'll do with it. And for Canadian oil sands producers in particular, many of their projects are much longer cycles, so they tend not to move or make changes based on short-term changes in the oil price. What I can say, though, is if you look at the past few years in the energy patch, the name of the game has really been about capital discipline. So the producers these days, especially the larger cap ones, are sitting on very strong balance sheets. They've been keeping a lid on CapEx, maintaining low production growth, and they've been returning the majority of their free cash flow to shareholders in the form of dividends and buybacks.
So that's the commodity itself, the producers. What about the other parts of the energy value chain? I'm thinking about pipelines, the midstream players.
Yeah, so the Canadian pipelines have seen a bit of a bid on the back of the higher oil price, however, not nearly to the same extent as the producers. And this is because, fundamentally speaking, the cash flow for the pipeline companies is very stable. It's all backed by the majority of it is backed by long-term contracts, or it's regulated. So they don't see the same volatility or uplift that a producer would. However, a higher oil and gas price environment does create a better backdrop for the pipeline companies. It means their counterparties are in a stronger position and might be looking to do more projects. So there might be more growth opportunities, again, longer run. However, conditions for the pipeline companies have been picking up a bit. They've spent really the past few years focused on deleveraging. That process is at an end, and there's been a bit of a tip up in their growth prospects even before this. The three main areas where they're seeing growth opportunities are the new and expanding LNG facilities across North America. It provides opportunities for them to connect gas to these facilities. The second is growing power demand, and that's driving new natural gas plants and connections, as well as opportunities for the renewables division. And lastly, Canada continues to work to increase its oil export pipeline capacity, so there's opportunities on those existing brownfield pipelines to expand. However, overall, pipelines are very big companies. They're still lower growth companies, call it kind of mid-single digit. But what the better project backdrop does is it pushes out that runway for growth even longer.
Earlier, you mentioned AI as a source of volatility. How has it affected the Canadian market?
Yeah, so it's been really amazing to see some of the swings in sentiment around AI related to individual names. Canada is rather fortunate in this regard. Yes, there are a few companies in the Canadian index that have been painted with this brush of being at risk of AI, but the vast majority of the index is either not exposed to AI risk, like the resource sector, it's pretty immune, or they have the potential to be beneficiaries of AI from an efficiency point of view. And when you look across the calls for financials, consumer or industrial companies, they're talking more and more about the AI initiatives that they have in place. And what these are centered around is really productivity, ways to lower costs, improve customer service, improve responding to potential revenue opportunities too. So what remains to be seen is how much of this will actually be a net benefit to the companies and drop to the bottom of the line. So that's something investors will be watching for over the next couple of years.
You mentioned financials there briefly. Let's dive into those. Obviously, it's a big part of the Canadian market. How are the financials looking, particularly the banks?
Yeah, so the banks were a big contributor to the 2025 return for the TSX, and that's because their credit stabilized and earnings improved. Now, the banks wrapped up reporting at the end of February, and the trends have broadly remained quite similar. On the positive side, they're continuing to see good growth from their capital markets and wealth divisions, and they've been doing a much better job of keeping a lid on costs. So they've been generating positive operating leverage as a group. As well, credit, as I mentioned, has been more stable, and they're sitting on a lot of excess capital, so that's allowed them to buy back more shares. The other thing to watch with the Canadian banks is a return on equity, which is a key metric for the banks, and that's been improving. I think there might be some more to go in terms of ROE improvement because some of the banks are still operating at levels that are below their midterm targets, and that's where better earnings growth as well as that buyback can help improve those ROE metrics. Now, one area that's been a bit weak for the banks has been loan growth. It continues to remain low, and people also always keep an eye out for credit. So I'd say on the positive side, unemployment in Canada has been more stable recently, and that's a critical metric for the consumer side of the coin. And the banks are also keeping a close eye on the outcome of the CUSMA negotiations and how that could impact the Canadian economy. So while bank valuations have expanded, I'd say this is reflecting the better earnings prospects, but also that strong capital position that they're sitting on.
Let's dive deeper into those CUSMA negotiations. Obviously, there's a lot of headlines right now that distract us from the fact that we need to talk with our largest trading partner, the Americans. How should investors be thinking about the potential impacts on Canadian companies?
Yeah, so certainly a lot of discussion, speculation, and uncertainty around the potential outcome from those negotiations. I'd say from the outside, Canada and the U.S. are important trading partners, so you hope that that can motivate some sort of reasonable deal. However, for the Canadian economy and the market, it's this uncertainty even during the negotiations that can be a challenge because in an uncertain environment, it makes businesses, hesitant to invest and grow. So this is what could keep Canada in that kind of lower growth rate for a while longer, particularly as it's probably going to be a complex deal.
Okay, we've covered off a lot of the big issues. Ultimately, though, we want to know about the fundamentals. What is underlying in terms of earnings growth, valuations? What is that telling us about the market?
So putting some of the geopolitical risks aside, the underlying key drivers of the equity markets and the TSX remain more supportive. So firstly, the global economy in Canada is growing. Canadian GDP growth has been low the past few years, but it's expected to continue to be low, but importantly positive this year. The other thing that's important has been the notable change in tone out of Ottawa. They're more focused on economic growth and promoting investments. which is a welcome shift in tone, but will take, of course, time to implement and actually see results. The second critical area for the TSX is that earnings growth is positive. So TSX earnings are expected to grow in the double digits in 2026. That's really important because if earnings are growing, that tends to drive the market higher over time. When you dig into the sources of earnings growth for the TSX, gold, with that big increase in the gold price, is an important contributor, but the other sectors are also generating some modest growth. The other thing that could change is really what happens with that oil price, because energy expectations currently look rather low. On valuation, the TSX is now trading just above its long-term average, so there might be perhaps less scope for valuation expansion, and that's why their focus is on the earnings. Importantly, though, the fundamentals of Canadian companies remain quite strong. We talked about the strong financial position of resources, of the banks. The life cos are also sitting on excess capital. And as big consumer and industrial names and technology names are also have strong balance sheets combined with good free cash flow. So this is a really good to have this financial flexibility. It allows companies to invest in opportunities, to withstand volatility, but also continue to take shareholder-friendly actions. So by that, I mean the TSX already has a dividend yield that's higher than the S&P 500 and has also been active on the buybacks too.
Quickly, I'll ask you, only got about 30 seconds, risks that anyone needs to be aware of.
Yeah, so we touched on some of the key risks being the CUSMA negotiations, broader trade and tariff risks globally. The TSX is always susceptible to changes in commodity prices, particularly oil and gold. And lastly, I'd say what's critical for the market is if growth can meet the expectations that are embedded in it. So there's already some expectation that growth is positive, and it'll be key to meet them. I'd say, though, the big positive factors for the equity market are that globally growth is positive, as well as earnings growth is expected to be positive. So those are two key supports that still remain at this point for the market.